Temporary, that is what they called it. In March 2023, when Silicon Valley Bank collapsed and the entire regional banking system was hours from implosion, the Federal Reserve launched an emergency lending program. They called it the Bank Term Funding Program. They said it was temporary. They said it was a short-term measure to restore confidence. They said it would end in 1 year. That was 2 years ago. And yesterday, buried on page 47 of the Federal Reserve's quarterly financial stability report, they quietly announced an extension. Year 3. Another 12 months. Another round of emergency lending to banks that are supposedly healthy. Another year of life support for an industry that claims to be thriving. When a temporary program becomes permanent, it is no longer a program. It is a confession that the underlying problem was never fixed, a confession that the banking system cannot survive without continuous Federal Reserve intervention, a confession that the crisis they said ended in 2023 never actually ended at all. The Fed is not extending the BTFP because banks are safe. They are extending it because banks are still drowning in unrealized losses. They are extending it because the next wave of failures would be catastrophic. They are extending it because without this program, your bank might not open tomorrow. Let me show you exactly what the BTFP is, why it exists, and what Year 3 tells us about the true state of American banking. To understand why the BTFP extension is so alarming, you need to understand what happened in March 2023. Because that was when the mask slipped, when the illusion of banking stability shattered, when we came closer to a systemic collapse than at any point since 2008. On March 8, 2023, Silicon Valley Bank announced they needed to raise capital. They had sold bonds at a loss to meet deposit withdrawals. The losses depleted their capital cushion. They needed fresh investment to stay solvent. Within 48 hours, the bank was dead. Depositors withdrew $42 billion in a single day, the largest digital bank run in history. By Friday evening, regulators seized the bank. It was the second largest bank failure in American history. But SVB was not unique. It was just the first domino. Signature Bank failed within days. First Republic Bank teetered for weeks before collapsing. Regional banks across America saw their stock prices crater. Deposits fled small banks and flooded into the too-big-to-fail giants. The cause was simple and terrifying. Interest rate risk. Banks had loaded up on long-term bonds when interest rates were near zero. Treasury bonds, mortgage-backed securities, safe assets, risk-free assets, the safest assets in the world. Then the Federal Reserve raised interest rates from 0% to 5% in 18 months, the fastest hiking cycle in 40 years, and the value of those safe assets collapsed. A bond that a bank bought for $100 in 2021 was worth $70 by 2023, a 30% loss. The banks did not have to realize these losses immediately. Accounting rules allowed them to hold bonds at purchase price as long as they did not sell. The losses were unrealized, hidden, papered over. As long as depositors did not withdraw, the banks could pretend everything was fine. But depositors did withdraw, first at SVB, then at Signature, then at First Republic. And suddenly, banks had to sell bonds at massive losses to meet withdrawals. The unrealized became realized, the hidden became visible, and the banking system nearly collapsed. The Federal Reserve panicked. They needed a solution, not to fix the underlying problem, because the underlying problem was unfixable without either crashing the economy or letting banks fail. They needed a solution to buy time, to restore confidence, to prevent the contagion from spreading. That solution was the Bank Term Funding Program. Let me explain exactly how the Bank Term Funding Program works, because understanding the mechanism reveals the depth of the problem it was created to solve. The BTFP allows banks to borrow money from the Federal Reserve using their underwater bonds as collateral. Here is the critical part. The Fed accepts these bonds at par value, at face value, at the price the bank originally paid, not at the current market value. Let me illustrate with an example. A bank holds $100 million in Treasury bonds that it bought in 2021. Because interest rates have risen, those bonds are now worth only $70 million on the open market. a $30 million loss. If the bank needs cash and has to sell these bonds, it gets $70 million. It realizes a $30 million loss. If the losses exceed its capital, the bank fails. But with the BTFP, the bank can take those same bonds to the Federal Reserve and borrow $100 million against them, the full face value, as if the bonds had not lost 30% of their value, as if the interest rate increases never happened. This accomplishes two things. First, it gives banks access to liquidity without selling underwater assets. They can meet deposit withdrawals without realizing losses. They can survive runs without becoming insolvent. Second, and this is the part they do not advertise, it transfers risk from the banks to the Federal Reserve. If a bank borrows $100 million against bonds worth $70 million and then fails, the Fed is holding collateral worth less than the loan. The Fed takes the loss. The taxpayer takes the loss. The BTFP is not a normal lending facility. It is a bailout disguised as a loan program. It is the Federal Reserve absorbing bank losses so the banks can continue operating as if nothing happened. Now, let me show you the scale. When the BTFP launched in March 2023, usage immediately spiked to 64 billion. Banks rushed to access the facility. They needed the lifeline. By the end of 2023, BTFP borrowing had reached 141 billion. The program that was supposed to be temporary and limited had become enormous and essential. Throughout 2024, borrowing remained elevated. Banks rolled over their BTFP loans. They did not repay. They could not repay. The underlying problem, $684 billion in unrealized losses across the banking system, had not improved. And now, with the extension into year 3, the Fed is acknowledging what was obvious all along. The BTFP is not temporary. It is permanent. It is a standing facility that the banking system requires to function. The banks are on life support, and the Fed just extended the ventilator for another year. So why is the Fed extending the BTFP now? What conditions in the banking system make year 3 necessary? There are 4 converging factors. Factor 1. Unrealized losses remain massive. According to the FDIC's latest quarterly banking profile, unrealized losses on bank balance sheets total $684 billion. That number has been remarkably stable for 2 years. It has not improved. The losses have not healed. Why not? Because interest rates have not come down enough. The Fed has cut rates slightly, but the 10-year Treasury yield remains elevated. The bonds that banks bought at 1.5% yields are still deeply underwater compared to current market rates. Until rates fall dramatically, the losses persist. The BTFP allows banks to ignore these losses, to keep bonds at face value on their books, to avoid selling, to avoid realizing. But the losses are still there, waiting. If the BTFP disappeared, banks would face pressure to sell, and selling would trigger the cascade that nearly destroyed the system in 2023. Factor 2. Commercial real estate is imploding. Banks hold approximately $2.7 trillion in commercial real estate loans. Office buildings, shopping malls, hotels, and commercial real estate values have collapsed. Office occupancy remains at 50% to 60% of pre-pandemic levels. Work from home is permanent for millions of workers. Office buildings in major cities are selling for 40% to 60% below their 2019 values. Some are selling for less than the debt owed on them. The loans on these buildings are coming due. Borrowers cannot refinance because the properties are worth less than the debt. They are defaulting. They are handing back keys. And banks are absorbing the losses. Regional banks have the highest concentration of CRE loans. The same banks that nearly failed in 2023 are now facing a wave of commercial real estate defaults. The BTFP provides liquidity to survive this wave. Without it, the defaults would trigger deposit flight, which would trigger asset sales, which would trigger failures. Factor 3. Deposit competition remains intense. Money market funds are paying 5%. Treasury bills are paying 5%. Why would you keep $100,000 in a bank savings account earning 0.5% when you can earn $5,000 per year in a money market fund? Deposits have been bleeding out of banks for 2 years. The smart money left first. The wealthy moved to higher-yielding alternatives. The deposits that remain are often from less financially sophisticated customers who do not know they have options. This deposit flight creates ongoing liquidity pressure. Banks need cash to meet withdrawals. The BTFP provides that cash. Without it, banks would have to sell assets, realize losses, and potentially fail. Factor 4. The Fed cannot let banks fail before the election. This factor is never stated but always present. A wave of bank failures would be politically catastrophic. It would trigger panic. It would crash markets. It would dominate headlines for months. The administration cannot afford a banking crisis. The Federal Reserve, despite claims of independence, understands political realities. Extending the BTFP for another year pushes any potential crisis past the election cycle. It buys time. It maintains the illusion of stability. The extension is not about banking health. It is about managing the timing of banking sickness. Historical precedent: 15 Sao Rinaus to 18 Sao. Temporary programs that become permanent are not unusual in crisis response. They are the norm, and the historical pattern tells us exactly what to expect. The Troubled Asset Relief Program. TARP was created as a temporary emergency measure to prevent financial collapse. Congress was told it would be limited and short-term. The government would buy toxic assets, stabilize banks, and exit quickly. TARP lasted for years. The government became a major shareholder in banks and automakers. The toxic assets sat on government books for a decade. The temporary measure became a permanent expansion of government involvement in financial markets. Quantitative easing. The Fed announced QE1 as a temporary emergency program to provide liquidity during the crisis. They would buy bonds, inject money into the system, and then unwind when conditions normalized. QE1 led to QE2. QE2 led to QE3. QE3 led to QE4 during COVID. The Fed's balance sheet went from $900 billion before the crisis to $9 trillion at its peak. 15 years later, they are still trying to unwind. Temporary became permanent. The repo market intervention. In September 2019, overnight lending rates spiked. The repo market seized up. The Fed announced temporary interventions to provide liquidity. They would inject funds for a few weeks and exit. The temporary repo operations continued for months. They morphed into standing facilities. They became part of the permanent infrastructure. The crisis that was supposed to be a one-week problem required years of ongoing intervention. The COVID lending facilities. The Fed created over a dozen emergency lending programs during COVID. Corporate bond purchases, municipal bond purchases, Main Street lending, all temporary, all emergency. Many of these programs were technically wound down, but the precedent remained. The playbook was established. The Fed demonstrated it would provide unlimited support whenever markets wobbled. That implicit guarantee became permanent even if the specific programs ended. The BTFP is following the same pattern. Year 1 was the emergency. Year 2 was the extension because conditions had not normalized. Year 3 is the quiet acknowledgement that normalization is not coming. By year 4, it will simply be how banking works. Nobody will remember it was ever supposed to be temporary. Let me explain exactly how the BTFP extension affects you personally, because this is not abstract monetary policy. This is about the safety of your deposits, the value of your money, and the stability of the system you depend on. First, your bank is weaker than it appears. The BTFP masks the true condition of bank balance sheets. Those unrealized losses are real, they exist, the bonds are underwater, the capital cushions are thinner than reported. Banks report capital ratios that look healthy, but those ratios are calculated using accounting values, not market values. If the accounting were honest, if bonds were marked to market, many banks would show capital ratios far below regulatory minimums. The BTFP allows this illusion to continue. Your bank looks healthy on paper, but paper can lie. The extension into year 3 tells you the lie is ongoing. Second, moral hazard is being reinforced. The BTFP teaches banks that risk does not matter. They can buy long-duration bonds at low yields, get caught by rate increases, and the Fed will bail them out. There is no penalty for bad risk management. There is only rescue. This moral hazard guarantees future crises. Banks will take risks knowing the Fed will intervene. The cycle will repeat, and each cycle, the interventions will be larger. The BTFP is training banks to be reckless. Third, inflation pressures remain. The BTFP is a form of money creation. When banks borrow from the Fed using underwater bonds as collateral, the Fed is effectively creating money to fill the hole. This is inflationary. It expands the money supply. It adds liquidity to a system that already has too much. The Fed claims to be fighting inflation through higher interest rates, but simultaneously, they are providing hundreds of billions in emergency lending. They are tightening with one hand and loosening with the other. The BTFP undermines the Fed's anti-inflation credibility. Fourth, your deposits are subsidizing bank survival. The BTFP loans are not free. Banks pay interest, but the terms are favorable. They are borrowing against collateral worth less than the loan amount. This is a subsidy, and ultimately, subsidies come from somewhere. When banks survive on subsidized lending rather than sound management, the costs are socialized. Taxpayers bear the risk. Depositors bear the consequences if things go wrong. You are not a customer to these banks. You are a resource to be exploited under government protection. Fifth, the next crisis will be worse. The BTFP did not fix the banking system. It paused the crisis. It bought time. It delayed the reckoning. But the underlying problems, the unrealized losses, the CRE exposure, the deposit flight, they all remain. When the next shock hits, when something breaks that the BTFP cannot patch, the crisis will be larger, the losses will be bigger, the bailouts will be more expensive. Year 3 of a temporary program is not a sign of stability, it is a warning of fragility. So, what do you do when the banking system is on permanent life support? How do you protect yourself from a system that requires continuous emergency intervention? Step 1. Understand that bank stability is an illusion. The BTFP extension tells you the truth. Banks are not healthy. They are surviving on Federal Reserve support. The quarterly earnings reports, the reassuring statements, the confident press releases, they are masking reality. Do not be complacent about your bank. Do not assume that because it has not failed, it cannot fail. The BTFP is preventing failures that would otherwise occur. When the support is withdrawn, or when it proves insufficient, failures will happen. Step 2. Diversify your banking relationships. Do not keep all your money in one bank. If that bank fails, your funds are frozen during the resolution process. Even with FDIC insurance, you might not have access for days or weeks. Spread your deposits across multiple institutions. Keep accounts at 2 or 3 banks. Consider a credit union, which may have different risk exposures than commercial banks. No single bank should hold more than $200,000 of your money. Leave a cushion below the FDIC limit. Step 3. Maintain physical cash outside the banking system. During the 2023 bank runs, ATM lines formed. Branches were mobbed. Access to electronic funds was uncertain. People with cash at home had options. People dependent on bank access did not. Keep 2 to 4 weeks of essential expenses in physical cash, not in a safety deposit box at the bank. At home. Secure but accessible. This is your bridge liquidity if the banking system experiences disruption. If you have minimal savings, keep $200 to $500 in cash. If you have modest savings, keep $1,000 to $2,000. If you have significant savings, keep $3,000 to $5,000. Scale to your expenses but maintain the buffer. Step 4. Build assets outside the banking system entirely. Bank deposits are promises. They are liabilities of the bank. If the bank fails, you are a creditor in line for repayment. Even with FDIC insurance, your claim depends on the system functioning. Physical gold and silver are not promises. They are assets you own directly. They do not depend on any bank remaining solvent. They do not require any government program to maintain value. If you have $500, buy 15 ounces of silver, physical metal stored at home. If you have $2,500, buy 70 ounces of silver and a quarter ounce of gold. Start building real money outside the banking system. If you have $10,000, buy 200 ounces of silver and 1 ounce of gold. Split storage between home and a private vault. If you have $50,000 or more, allocate 20% to 25% to physical precious metals. This is your insurance against a banking system that requires permanent emergency support. Step 5. Monitor your bank's health indicators. Watch for news about your specific bank. Watch for declining stock prices. Watch for executive departures. Watch for credit rating downgrades. Watch for unusual deposit outflows. If you see warning signs, do not wait. Move deposits before the crisis hits headlines. The people who lost access during the SVB collapse were the ones who waited until Friday. The ones who moved early preserved their liquidity. Step 6. Reduce dependence on the system. The BTFP is a symptom of a fragile system that requires constant intervention. That fragility will not improve. It will worsen. Build a life that depends less on the banking system functioning perfectly. Pay down debt. Build savings. Acquire physical assets. Develop skills that generate income regardless of financial system stability. The more independent you are, the less vulnerable you become. The Bank Term Funding Program was temporary. Now it is in year 3. The emergency is permanent. The bailout is ongoing. The banking system requires continuous Federal Reserve life support to function. When they tell you the crisis is over, watch what they do, not what they say. What they are doing is extending emergency programs year after year. That tells you everything. But the BTFP is only one indicator of banking system stress. There is a specific metric the Fed monitors internally that tracks the probability of systemic failure. It has been classified for years, but a recent FOIA request forced partial disclosure. And the number they revealed is the highest reading since October 2008. I break down exactly what that metric is and what it is telling us in this video right here. Click it now. The BTFP extension is the symptom. The metric reveals the disease. I will see you there.